The AI sell-off you're watching right now doesn't line up with the data, and that's exactly why it's dangerous. And I'll be honest, this one made me feel uncomfortable. I'm heavily exposed to tech and AI, and some of my positions have been down over the last few weeks. So what I did is what I always do. I went back and tried to break my own thesis. I watched the biggest bears on YouTube and X, wrote down their main arguments, and basically came up with the below. Still, my core belief hasn't changed. AI is not a bubble. It is a structural shift that will define productivity and profits for the whole next decade. After digging into funding, earnings, macro data, and sentiment, here's my conclusion up front. This sell-off is being driven far more by psychology and positioning than by fundamentals. And by the end of this video, you'll understand exactly what's causing it. So let's talk about why AI stocks dipped this week. And the key thing to understand is that this wasn't driven by Nvidia or hyperscaler demand or anything fundamentally breaking in AI. It was driven by negative sentiment coming from the tail end of the ecosystem. Specifically, we had headlines around Blue Owl stepping back from funding an Oracle data center project linked to OpenAI. The hangup was essentially over lease terms. Lenders are getting pickier about Oracle's $100 billion debt pile and wanted stricter guarantees than Oracle was willing to give. That's a financing decision around one project, but the market treated it as if it said something about AI demand more broadly. And when sentiment turns negative at the margins, it tends to spill over very quickly into the highest quality names. Now, what's interesting is that if you zoom out on Nvidia's stock price, which I think is a pretty good indication of the industry as a whole, this exact pattern has already played out multiple times this year. You know, earlier this year, we had headlines around DeepSeek and other low-cost AI models out of China. The narrative at the time was these models could commoditize AI and hurt the incumbents. And if you look at Nvidia's chart, you'll see that sharp pullback right around those headlines, but nothing broke. Demand didn't slow, capex didn't reverse, earnings didn't disappoint. Then in April, we had macro headlines, hotter inflation data, rates repricing, and concerns that cuts might get pushed out. Risk assets sold off across the board, and AI stocks were no exception. Once again, of course, Nvidia pulled back, and once again, nothing structurally changed with the company. And then, of course, more recently, Google's Gemini started taking the lead in performance benchmarks, and sentiment has swung hard in that direction. Anything linked to OpenAI saw valuation compression, even though the overall AI spend hasn't changed. Again, you see it right here on the Nvidia chart, a pullback driven by narrative rotation and not fundamentals. So when you look at the last week's move in context, it fits a very familiar pattern. Tail-end issuers create negative sentiment, narrative shifts, macro headlines add noise, and the highest quality names get sold indiscriminately. But every single time this year, the fundamentals have eventually reasserted themselves. So if AI were actually slowing down, where would we see it first? We wouldn't see it in the headlines, we would see it in the money. And when you look at how this AI build-out is actually being funded, the story looks very different from the fear we're seeing in the market. At an aggregate level, AI infrastructure investment is now approaching $1 trillion run rate. But here's the critical distinction. The majority of that spending, roughly $400 billion from the hyperscalers alone, is being funded primarily through their own operating cash flows. These aren't speculative startups relying on easy credit. They're the most profitable companies in history, reinvesting their own earnings. Yes, some are using debt margins to optimize their balance sheet. Meta's recent multi-billion-dollar bond offering are actually a pretty good example of this. But it's also important to remember that Meta's credit profile is arguably more stable than many sovereign governments. So when you see headlines about funding stress, you have to look at where that stress actually sits. It's not at the core, it's not at the edges. Companies like CoreWeave, which has seen its stock price hit by debt concerns, or specific Oracle data center projects caught in financing stalemates, those are execution and structure issues at the margins. They are not demand issues at the core of the AI ecosystem. If AI demand were genuinely rolling over, we'd see it very clearly. We'd see Microsoft or Google cutting capex guidance. We'd see Nvidia order books thinning out. Instead, we're seeing the opposite. These companies are doubling down because their returns on investment is already showing up in their bottom line. So if funding isn't the problem, the next question becomes timing. When does the next real inflection in AI actually arrive? There's a tendency to talk about Nvidia's Blackwell platform as if its impact should already be visible everywhere. But hardware deployment and model impact don't actually happen at the same time. Blackwell hardware is rolling out right now and will continue through right up until the end of this year, of course. But the first major frontier models, the ones trained from the ground up on Blackwell's architecture, aren't expected to reach the public until early 2026. What we're seeing right now isn't a broken growth story. It's a timing mismatch. The spending is real, The infrastructure is being built. The models just haven't landed yet. And when they do, the narrative tends to shift very quickly. So if demand is real and funding is intact, the next place to look would be earnings, right? Because earnings are where stories get exposed. And when you look at the actual results coming out of the AI ecosystem, they tell a very different story from what the price action suggests. Many of the largest AI exposed companies aren't just growing, they're growing exponentially. They're growing at extraordinary rates. We're talking about some of the biggest companies in the world delivering revenues of north of 50%. Now the next question is valuation. Not whether these stocks look cheap in isolation, but whether their price makes sense relative to their growth. Take Nvidia for example. You have a company still growing revenues north of 50%, trading on a forward multiple that's well below where it traded earlier in the cycle. When you adjust that valuation for growth, Nvidia is actually cheaper than many much slower growing companies. And when you widen the lens further, the disconnect becomes even clearer. Companies like Walmart or Costco trade at very high multiples relative to growth because their earnings are stable. What's unusual right now is that some of the fastest growing companies in the market are being priced as if their growth is about to disappear. And when you line up earnings and valuation side by side, that assumption simply doesn't hold, which is why this sell-off looks far more like sentiment-driven multiple compression than a genuine deterioration in fundamentals. So if earnings aren't the problem, the next question is macro. Is the broader environment actually turning up against risk assets, or is the market overreacting? We've just had some slightly hotter jobs and inflation data recently, and that's pushed expectations for rate cuts further out. That kind of data always creates short-term volatility. But when you zoom out, the macro picture is still broadly supportive for risk assets, especially looking into 2026. Markets are currently pricing in a couple of rate cuts next year, and importantly, we're approaching a change in Fed leadership, with a new chair expected to be appointed by Trump. This is why a lot of strategists, including people like Tom Lee, are constructive on equities into 2026. And it's not just like one or two voices. If you look across major banks, their expectations for the S&P into the end of 2026 are broadly aligned with one another for a very strong year. That matters because AI and tech don't exist in a vacuum. When macro conditions are stable to improving, high growth, cash generative companies tend to benefit the most. So when you put all this together, the picture becomes much clearer. The recent pullbacks in AI stocks wasn't driven by a collapse in demand. It was driven by sentiment, tail end funding stress, shifting narratives, and short-term macro noise. At the same time, the core pillars of the AI story haven't changed. Funding is still coming primarily from operating cash flows. The largest buyers are still spending aggressively. Earnings are still growing, and real-world adoption is continuing to accelerate. Markets don't move in a straight line. In the short term, they can react to uncertainty. In the long term, though, they generally follow fundamentals. What we're seeing right now looks far more like the disconnect between price and reality than a breakdown in the AI thesis. That doesn't mean there's no risks here, and I don't mean every AI-related stock is a buy, but selling purely out of fear without reassessing the underlying data is rarely a good strategy here. If you've been sitting on the sidelines, this is the kind of environment where it makes sense to slow down, do the work, and be very selective. And if you're already invested, the real question isn't whether the market feels uncomfortable right now, it's whether the reason you bought in the first place has actually changed. Anyway, that's it for the video. If you found this breakdown useful, feel free to subscribe. I keep focusing on what the data is actually saying, not the noise. Thank you so much for watching, and I'll see you in the next one.